Brad Williams, Frugal Finance Mortgage. You're looking at buying your first home. Where do you start? Well, clearly, you're going to need a sizable down payment. You have your normal process. You're going to search for a home, location, so on and so forth. But one thing we don't do as much as we should is that we don't shop for the mortgage loan. We don't spend the time to try to find the most favorable programs out there. Why? Well, it could be a little intimidating. It's so much easier just to go online and look at one particular rate because everyone else is using that company and thinking that's the most favorable program. You need to shop around, believe it or not. And I have it somewhere in a video where only 13% of people shop for a mortgage. 13. That's leaving 87% of you just taking it for granted that the interest rate, the programs that you're approved for is the most favorable. Don't fall into that practice. It's not a good practice. So how do I find the best loan available when I'm shopping for a home mortgage loan? FYI, I used to own a mortgage company long ago. I worked with anywhere at any point in time from 5 to 15 different lenders, and I'd have their information in front of me. And not always would I shop for the lowest rate. Why? Because some underwriters, some lenders were just a pain in the butt. You have to keep that in mind. If you go strictly to Bank of America, you're so strangled by and I rarely sent a loan to any large bank. Why? Because their underwriting guidelines were just a pain in the butt. Their employees were all Muppets. They're just so strict, so corporate, so indoctrined by their inflexibility. And to this day, I would not send a loan to a Citibank, a Bank of America, a Chase. Those are some of the companies that try to do business with me. Their account reps would be knocking on my door, and I'd just say, look, I don't like you people, period. That's helpful because they leave you alone. Bank of America, they're horrible. Well, even though they may have some great programs, my God, their underwriters were just a pain in the butt. That's what you have to think about. It's not only the most favorable rate, it's how do I qualify for a loan? My recommendation is to try to work with a mortgage broker. The mortgage broker, if they follow the same kind of guidelines I did, their job is to get you qualified. And if they've been in business and you want somebody who's been in business at least 5 years, they've gone through the turmoil of working with good lenders, good mortgage bankers, or banks. Now, there's nothing wrong with a mortgage broker that has a suitable relationship with a Bank of America. I never did. I never had a suitable relationship with Chase or JP Morgan or at the time Wells Fargo. I just didn't like their protocols. I would work with mortgage bankers, and a mortgage banker will package up the loan and then they'll sell it. They'll sell it to Fannie Mae. If you can find a small mortgage banker, they have a lot more leadway in terms of their underwriting capabilities. So that's just some of the things you want to keep in mind. Shopping around for a mortgage will help you get the best deal. Start with an internet search or contact banks, credit unions, and other lenders and brokers in your area. Now, I didn't do much in the way of credit unions. Why? Again, they're a silo. They have a department. They have their underwriting guidelines, and there's very little flexibility. Same with banks, but mortgage bankers and mortgage brokers have a little more flexibility. Why? Well, you have a number of different underwriting requirements, and Fannie Mae, and Freddie Mac, and Ginnie Mae, and other platforms are different. And some of these institutions perhaps would underwrite it in-house under a different program that you're not aware of. Whereas with a mortgage banker, mortgage broker, you're going to probably have your loan underwritten by Fannie Mae. And then Freddie Mac is a second choice. If you're doing a VA loan, VA loans have their own underwriting guidelines. But again, it's just up to you to talk to the folks and ask them these questions. Who's underwriting the loan? What is your acceptance rates? In other words, how many people are declined? And they're not going to give you that information, but at least you can ask. This is just the preliminary. This is the foundation. If you have a 720 credit score, you have a ton of money, and you're putting 20% down or more, then you have a lot of flexibility. But if you're a first-time home buyer, coming in with 3%, you have minimal cash, You're asking for assistance in every way possible. You're a first-time home buyer. Your cash position is okay. The only thing that's supporting your qualification is you've been working in the same job for 3 years and you're showing an increased income, or you and your spouse or your partner are showing an increase in income, great credit scores, and a little bit of cash. Well, that's a challenge. That's a challenge because you're putting the leverage on the lender. And subsequently, your underwriting requirements are going to be a little bit different. Typically, the large banks, they're going to quickly shy away from doing business with you. So my recommendation is to consider working with bankers and brokers. Shop around. It doesn't hurt to call a credit union. It doesn't hurt to call a bank directly. But the internet is a good place to start, clearly. Then contact banks or credit unions, mortgage brokers in your area. How do you find a good mortgage broker? Word of mouth. Don't fall in love. Do not do this. All right. Do not allow that real estate agent you're working with to push you to use their in-house lender. Don't do it. Why? Because that mortgage broker is affiliated with the company, and if there's an affiliation, that real estate agent is getting some kind of compensation for keeping that loan in-house, and you're not going to get the best program, period. So don't do it. This is what you're going to want to do. And again, I don't agree with some of the stuff posted here. This is from CFPB. They're pushing the lowest rates and lowest fees, are looking for a comparable program. In other words, first, will you qualify? If you qualify, if you're a grade A type borrower, then you should shop for the best rates, best terms. But if you're borderline, in other words, you think you're on the fence going, I don't know if we'll qualify. Then it's a matter of, well, we're looking for a resource that can somehow pre-qualify us for a particular loan. And that's what this video is all about, is not the AAA borrower, but you would be considered an A from a AAA to a AA to an A. And then B, C, and D would be a whole different category. And if that's the case, then what's your priority? Well, getting qualified. Now, there's always a loan available. Keep that in mind. There's always a loan available. It's just a matter of your terms. It's called hard money. And there's hard money lenders out there that are vultures times 2. But there's always money if you're willing to pay the rate and allow the lender to pretty much control your life, and don't do that. If you can't afford your loan, then hold off, save more money, and then go back a year later or 6 months later to try to qualify. But don't try to push it. Don't be pushed into a lower quality loan because you don't have a large enough or down payment. Keep an eye on the fees. Consider your APR. In other words, don't get caught up in the weeds. And that is huge fees. What I mean by fees, don't pay points. Do not pay points ever. Ever, don't. I could show you the math. There's no advantage to paying points. The problem you're going to face here is when you're working with a mortgage broker, you may be working with just an employee or somebody associated with the company. Well, they're going to try to charge you a point because that's what they make. Then the house makes everything else. Don't fall for it. Bump up the rate 1/8% and then allow them, it's called a rebate. Let them be compensated by that 1/8 of a point. That should be about 7/8 of a point to them, maybe 5/8, and that's enough money. And on a $500,000 loan, they shouldn't be making any more than $2,000. It's not that big of a deal to underwrite a loan. It really isn't. I was able to do it. Total time when I was doing home purchases way back when, and I computed how much time it took me from beginning to end, and it was about 3 hours. And that was on a challenging loan. And that includes driving, taking the app, dealing with the loan processors, the underwriting side, the funding side, so on and so forth. So 3 to 4 hours. And I'm thinking $1,800 is more than enough compensation for 3 to 4 hours of time. You can do your own math. But I had 20 plus years of experience. I knew exactly how much time I spent in terms of the loan process. Whether the rates given for various products are fixed or adjustable, keep in mind, stay away from ARMs unless that's the only avenue you have to qualify. The problem there is you have that adjustment feature, and if you're caught in a market where interest rates skyrocket, you're going to be trapped. And there's nothing worse than seeing your monthly payment go from $1,000 to $1,200 to $1,400 to $2,000 in a 1-year period. That means your payments increased twofold. Are you in a position to handle that? These are just some of the areas that you need to focus on when you're looking for the home mortgage. Now, we always try to go in and say, well, I need the lowest interest rate. Well, yeah, that's the obvious. But then there's a lot of other criteria you as the borrower need to take into consideration. So here are a few tips. Is the interest rate fixed or adjustable? Be very careful here. Even on a 5-year. I have a bunch of videos on 5-year and adjustable rate mortgages. Take a look. Do I need to pay points? Never pay points, period. What fees will I have to pay? Will I pay those myself, or will the lender loan the fees to me? Try to avoid that also. When you're buying, try to stick all the costs to the seller, always. What is the terms of the loan? Don't get caught thinking you have a 30-year deal and somehow the unscrupulous individual you're working with threw you into a 5-year deal. Next thing you know, you're at the 60th month and all of a sudden you have a $400,000 balance that needs to be paid off. The same holds true in terms of adjustable rate mortgages. It's called negative amortization. This was the trap so many people fell into back in 2007, 2008. Where unscrupulous individuals were telling people, look, your monthly payment's only going to be $1,000, only to find that the $1,000 was the payment, but their loan balance kept increasing because it was a negative am. The actual minimal monthly payment would have been $1,600, so $600 a month was being added to the balance. So they were upside down in no time at all. And subsequently, that's why tens of thousands of people lost their homes in the meltdown. Don't be surprised if we see that stuff popping up again here in 2006, 2007, 2008, because there won't be a regulator overlooking that information. CFPB has been neutered. There won't be an agency that's looking out for you as the consumer. How much will my payment be, and will it eventually pay off my principal? I always suggest, if you can, try to do a 15-year mortgage, period. It's called forced savings. That means you give up a lot of other things. Why? If you can pay off your mortgage in 15 years, that's the equivalent of nearly $600,000 in the change of money. What do I mean by that? If you pay off your mortgage and then in 15 years, the interest savings alone is going to be about $200,000 on a $500,000 loan. Then you put all of that money into reinvestment, making 12%. You take that interest that you save, turn it into an investment for 15 years, and that's going to be about $600,000. That's how big the change is. I haven't penciled that in. I'm kind of just shooting from the hip here, and I may do that number just to see the difference. What other costs will be added to my monthly mortgage? Can I repay the loan early? Do not ever, ever get stuck in a prepayment penalty, ever. Will the payments change over the life of the loan? How high can my payments go? From an adjustable rate mortgage, are the payment adjustments in the interest rate cap? All interest rates need a cap if they're conforming loans. How much will I need to put down? Does the written offer match what I was told about the loan? Just a few suggestions. Comment, let me know. If this is confusing, if you're in the process, you were told one thing, then reality struck. The documentation is not even close. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.